Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Connect, President of Universal Accounting Center, and this is a podcast dedicated to helping you as you work on building the premier accounting firm in your area, offer quality accounting services, and most importantly, get paid what you're worth. It's in this podcast that we bring on the experts, have them share with us insights as it relates to your business and servicing your clients to ensure that you're actually doing the things that you should as you're working with them. Now, as we're going through this, one of the things that I'd like to point out is each and every week I have on the show an expert, and today's going to be no exception. We've got basically Craig Primo. You're going to be here now for the second time on the show. We're going to go a little deeper into things as it relates to selling a business, some of the best practices, things that you need to be aware of as you're working with your clients to ensure that they're getting the most valuation out of their company and are best prepared for that transition. So, Craig, welcome to the show.
Thank you. Thank you for having me back.
Yeah, this is going to be a lot of fun. So I've been really thinking about our conversation today because I think it's very, very relevant. It's relevant with the clients I service. It's very particular to me with my business. I mean, obviously, everyone should be looking at it from the beginning with the end in mind philosophy.
Right.
But so let's kind of couch who you are and what it is you do as it relates to business.
Sure. I am a FINRA licensed investment banker. K2 Securities is my firm. It's three of us. I'm one of the principals, and I have two other business partners. And we help business owners effect a sale of their business. My ex-wife used to hate when I said this, but we are to a $50 million business what a realtor is to a house. Mm-hmm. We also help companies get ready to assume big debt. We could fee off of a big credit facility in a capital raise, for instance, and we've done that. So our job, though, is to get clients ready for a transaction because we don't get paid unless a transaction occurs.
Yeah.
So part and parcel of that, we have to help them get ready, and that always involves accountants.
Yeah. Now, from an accounting perspective, we're clearly doing the books, we're doing the bookkeeping, we're doing the accounting, looking at the reports, we're helping them from a tax perspective. There's a lot going on behind the scenes, but when it then finally comes to this transaction, you're leaning on us as an accounting profession to have everything in order, set up, and hopefully current, accurate.
Right.
Yeah.
Right.
So what I want to do is pose some scenarios to you. And as I pose these scenarios, kind of glean from you maybe some best case situations. And what I'm saying is my audience, they're working with clients at various stages. And I presume that what they're going to hear is going to be relevant to what they're dealing with currently and more importantly in the future. So let's kind of start with this first scenario. You're dealing with a business, they're established, they're running, they're operating, and then unexpectedly something comes along and there's a life transition for the owner. There's something that's necessitating that they sell the business. We can go into a variety of reasons as to why that may have unexpectedly come, but you come into the situation, you're called in to actually help with that transaction. What are you looking for? What are you expecting that the accounting profession has done to position that business in a situation that's favorable to the owner?
Well, in a situation you just outlined, nobody has been preparing actively for a transaction
That's right.
because they thought it was 5 years, 10 years down the road, maybe. I can understand. I know how this industry works. Clients don't always follow the advice of spending more money on accounting. So in a situation like that, again, a $50 million business is a typical business that I would work with. But even so, you could be surprised. Sometimes these $50 million businesses have the same accounting practices they had when they were a $5 million business.
Yeah.
And they just grew up, right? Because if they're growing fast, it wouldn't take that long to get from $5 million to $50 million. And maybe they just haven't had time to sharpen the saw, accounting-wise,
Yep.
right? And spend the money on accounting. So in that scenario, we're going to do the best we can. The client it's going to be a more painful process for us, for the client. If their financials are not per GAAP and they can't answer questions about gross profit margin trends over time. They can't answer questions about, why is your inventory falling or rising in any between months. They don't have the proper accruals in there. They're going to need to go back and fix those and get those accruals in there by month, so we can march towards a close. So we can do it all. It's more painful to do it in real time, in the middle of a process. The buyer is going to apply discounts, and some buyers will pass because of the hair on the deal. Mm-hmm. Some buyers will see opportunity and they'll they'll take the knife out
pounce.
a bit, right? Well, but then other ones will say, "Well, I'll do it, but we're going to do it for 90% of what we would have paid for." So millions of dollars are lost.
Yeah.
But it's okay. You're giving a scenario where they need to get out.
Yeah. So the one thing that I'm hearing you say is, from an accounting perspective, there's a lot of ratios that are necessary because you have to account for what is the relationship of the numbers as it relates to the business. And so I'm hearing liquidity ratios, current ratios, financial ratios. These are numbers that hopefully the accounting profession can now give you because they're current with the numbers, but more importantly, they've been watching or tracking them, because I'm assuming that there's certain indicators that determine the vitality of the business, the profitability of the business. What are some of those ratios that might stand out to you that are either very important to you as you're assessing the valuation of the business, or more importantly, that you want to present as part of the portfolio to a potential buyer?
Buyers don't ask a lot of questions about ratios. I
Interesting.
know that is a 201 accounting.
It's what I'm looking
Right?
at. It's what I
Sure.
watch.
I understand. You should, and it's smart. It's a good way to operate your business. They're going to ask questions about trends, mostly focused on gross profit.
Okay.
Give me a breakdown of, well, they won't ask questions. They'll ask to see reports, and they'll come to their own conclusions. So give me a report of gross profit margin by line of business over time, by customer over time, by SKU over time, right? And then they'll want to have like a deposition level questioning about why this happened, why that happened. And with those reports and with interviewing the entrepreneur, they should be able to get to the answers they're looking for. They'll ask those questions, and if they commission a quality of earnings professional, he or she will ask those questions too. So, but if your chart of accounts isn't built properly, and you're not recording the proper accruals every month and inventory, et cetera, you're not going to be able to produce these reports as crisp and tight as they're gonna want. You certainly will 2 years after they buy your business.
Okay. So maybe this is rapid fire. I'm kind of curious about the ratios, even though you said they're more important to me than
Okay.
perhaps to you. I'm curious which of these even matter, because they're the ones I'm looking at. So you've got cost per customer acquisition. Does that matter? Knowing the trends associated with that cost per acquisition?
That matters. I mean, when you're talking about a SaaS business, there's definitely a set of metrics that are a different vernacular than a regular business,
Okay.
right? You want to talk about churn, net churn,
Yep.
right? These sorts
Good.
of things. So maybe those can be expressed as ratios too.
Okay. Lifetime value of a customer
Yes,
and what that trend is, whether it's going up, down.
right.
Yeah. Debt to equity,
Not so much.
current ratio.
No, that's like you're talking. What's next? Like a liquidity, like a acid test ratio.
Yeah.
We don't have a lot of those questions asked by
Interesting.
buyers. Yeah.
Okay. So now you're in a situation where, as an accountant, we're doing the books. You come in, the transaction's going to happen. You've asked these questions, but I'm going to change the scenario. The scenario is I'm actually planning for an exit. I'm looking for the exit.
Yeah.
What were the things that in the next year or 3 years I should be prioritizing that are going to help me paint the best picture as it relates to the business?
Okay. So this is a better scenario for everybody concerned.
Mhm.
You're going to spend less on accounting because it's going to be done over a period of time, and your accountant can actually work the business in the slow season, where is slow season? I don't know. These guys are also busy, but it won't be done on an emergency basis. You won't be pressurizing yourself and your CFO to produce these reports. So what I would say that you would do is you need to get to the point where you can produce GAAP financials in Excel by month. Okay, so when I see GAAP financials, or when I see financials by month in Excel, I can figure out how much they're spending on accounting because, the inventory number is the same every month. There's no accruals in here for payroll or vacation accruals by month. That's the level of detail you need to get at to really track working capital on a rolling 12-month basis. To do that, you have to understand the true earnings of the business by month. And that's how you figure out the earnings of the business, but also you calculate the appropriate level of adjusted working capital because it's on a 12-month look back. And it might take a year to get that implemented properly, changing your chart of accounts and everything. And then you need optimally, you need a 2-year history to look back, certainly a 1-year history to look back to properly calculate adjusted working capital. So you're thinking about doing something 3 years out, get to work now. Absolutely get to work now.
Okay, so one of the things that you described is something I do, which is I export my financials via CSV file to Excel, and I start to do that analysis. I'm using it for forecasting, budgeting, and I'm looking at my analysis of what's going on as it relates, one line to another. What's my total income as it relates to gross profit? What's my gross profit as part of payroll and so forth?
Right.
So I'm going through that process to assess what are those correlations, because if I knew that I'm spending, say, 20% of my payroll or gross profit in payroll, then I'm going to be more sensitive to that change over the years. In fact, it just came up this morning. We were discussing how it's changed over the last 5 years as it relates to our revenue. That's an important thing because we want to see what's that correlation. Are the people that are on payroll producing as they once did? And more importantly, can we affect then management? Are we top heavy at this point? Is there something going on that we need to be sensitive to? Because clearly it has changed. And one of the things that's very important is, are we actually adjusting for inflation appropriately with the cost of our programs so that I can increase the top line revenue to counter what it's costing me to pay people? So, there's a lot of things that are moving parts within the business, but the Excel exercise that you're describing has been hugely beneficial to me as I'm running the business. So I do like that. All right. So
by the way, I should also say too, to go back for a quick second, if you're producing for the buyer the proper data, they may be running a bunch of ratios that I'm not even aware of in the background.
As a buyer,
right? Because always if they're paying for a quality of earnings test, they're not handing that over to us, right? I never see that unless the client commissions his own quality of earnings test, which is the gold standard these days, and they should be doing that.
Yeah.
And your clients, your accounting clients in general, should be able to articulate to their buyers and to their clients and prospective clients why they need to spend this money, why they need to do it now. What's the cost to not do it?
Yes. No, the whole thing that we're trying to emphasize here on this show is the fact that there is a value in accounting, but more importantly, we need to be proactive as it relates to our clients. To simply provide financials and walk away and assume we're done isn't enough. To simply file and prepare and file the tax returns isn't enough. We've got to be in a position where we're engaging with the client, helping them understand what's going on with their financials, and more importantly, kind of draw attention to things that need their attention as they're running the business. So all right. So
they don't even know the right questions to ask the accountant.
Yeah.
And here's the thing too. You've got entrepreneurs who I'm very impressed with. I've had a front row seat to wealth being created my entire career. It's impressive. Accountants, very smart, very detailed, extremely important. Both parties need what the other one has. And it seems there isn't enough training that goes really between accountants and entrepreneurs. Accountants need to become more entrepreneurial, and entrepreneurs need to understand the language of business better to run their business.
That's very well said. One of the things that I think is important about that is the fact that as accountants, we don't necessarily understand the mindset of the entrepreneur. They're much more risk prone. They're willing to take those challenges and pursue those opportunities. And traditionally, it's more a generalization, but the accountant is typically more reserved and they're trying to be a little bit more cautious with things. The nice thing is to find what I refer to as an accountrepreneur, someone that is of the mindset of running an accounting business. They're willing to run it as a company and at the same time offer accounting services. And if you can find that individual, typically they're able to work well with the entrepreneur because they're equally doing the same thing.
Absolutely.
They're running businesses.
I've also seen too, you see a lot of burnout in accounting, right? I'm not an accountant, but I would believe that an accountant that is on a treadmill doing the same thing, looking in the rearview mirror the entire time, right? That's in the rearview mirror instead of the windshield. I had to believe it's a richer experience for that accountant to get enmeshed with his entrepreneur clients and teach them, train them, mentor them, coach them. It'll probably it'll make more money for the accountant. It'll be a more interesting job. It'll elongate their career because they won't be as I don't know, on a treadmill, looking at the next quarter, looking at the next deadline.
Well, I'll add to that the fact that when I've worked with my clients, there's a creativity that is so fun when you're actually now able to take the financial reports and ask the question, therefore what? What does this mean? And it does go to the trends that you were alluding to at the beginning. It's not just the reports, it's now the analysis of the reports to say, okay, what's happening with these various things? And if it's, revenue per client or whatever the question is, we're able to see, okay, there's a story being told here, and it's either a good story, things are getting better, we're getting smarter with what we do as a business, or the business is being affected by internal or external factors that's impeding our growth, and we're having to adapt and change. Something's always needing attention. And as a business owner, there's value in the numbers. Accounting is the language of business. It's speaking to us. So often the business owner struggles to know what it's saying, and that's the role of the accountant to come in and interpret that information. Here's what this is saying to me. And sometimes there's this red flag, a blaring sound, it's an alarm, and the accountant isn't bringing it to the attention of the business owner. They're unaware, but yet it's right there in front of them. So yeah, this is a very important conversation. All right, so as it relates to the business, you alluded to something that is counterintuitive to my thinking, and it might be applicable to the third scenario. So I'm going to ask it, and then we'll go into the third because I think it's relative. But you keep bringing up the fact that debt is good. And I've heard you say that last time, this time, and I'd like to understand that simply because of the fact that that's not how I was individually or personally raised, and business-wise, that's not how I run the business. I want money in the bank to cover payroll for a period of time. I want money that if an opportunity presents itself, I can act. And yet I hear you leveraging debt quite a bit and say that's to the advantage of the valuation of the business. Am I hearing you correctly?
Can put you out of business too.
Yeah.
Can lever profits and lever losses too. Look, I'm an entrepreneur too. I own another business which is very capital intensive, and we have a ton of debt. And I look at that balance sheet every day and I sweat about it. Right.
Yeah.
So a fire can save your life. It can cook you food. It can keep you warm, or it can burn down your house. And debt is like a fire. You have to be able to control it. I say debt is good. You can certainly use debt to your advantage to grow the business. Absolutely. I know in the sale of a bit, I think what you're saying is in the sale of a business, you were saying before that this business has no debt. So it's more,
I said that before.
Right. Exactly. Yes. That's really not true. That's not really relevant in the sale, because every single sale is debt-free, cash-free. I mean, they're going to pay off the debt anyway. So they're not buying your debt. Your debt is not assumable. They're going to put in place their own credit facility. So it didn't matter that you showed up with no debt. Let's say they were buying a business that has no debt.
Okay.
They're going to lever the heck out of it at closing if it's a private equity group. Again, I'm always thinking private equity group because they own the world now. They own many of the strategics. So maybe a strategic is buying your business, but there's a guy in the background that is the private equity guy that owns the strategic.
Okay.
And he is leveraging these balance sheets, these American balance sheets, and using debt, until recently cheap debt, to increase their rates of return, their internal rates of return. So it is no, I won't say it's good, but it's of no advantage that you market a company that it's debt free. It doesn't really matter.
Okay, so is there a good amount of debt versus a bad amount of debt? Could you be over leveraged?
Of course.
Okay, so what does that look like then?
It really depends on the business. It depends on your risk tolerance. If you are a guy, and I meet a lot of entrepreneurs in Utah that are culturally conservative. They hate debt. They hate the idea of debt. They got a story about debt. Look, so for them, it makes perfect sense to not have any debt. And I would not encourage them to go get debt. I said a couple of years ago, and many of us struggle with this with our spouses. I know I did. That, hey, we can pay off this house and we could own this house for cash if we wanted to right now, the one we live in. And I said, why would I do that? They're offering 2% money. Leverage this house up to the hilt. And you look back on it now, people that didn't leverage their house up, they don't really have much of an advantage. Somebody who has 2% debt on their house, they're sitting pretty. They can't get that, right? It's like a bond that you buy, and interest rates go down, and the value of that bond goes up. It's the same thing with the debt. If you have debt at low rates and then rates go up, now you're locked in on that debt. It can be very beneficial. So it depends on the business. It depends on the personality.
Yeah.
It also depends on if they're asking for a personal guarantee or not. No one likes personal guarantees. I do not. I'm stuck with them right now in this other business that I own. I hope to get out of them someday.
Yeah, yeah. Okay, so are you familiar with the term zombie companies?
Yeah. Are you talking about like a software company, for instance, that is not a rocket ship and not going out of business? They call it a zombie?
Well, they're referring to basically it's undercapitalized. It's running, but more or less what you're dealing with, as I understand it, is a business that for whatever reason exists, but it's clearly not profitable. And it's leveraging, for example, the debt to pay whatever expenses it has. But as the debt becomes more and more expensive to acquire, the life of that business is now determined because as the interest rates go up, it can no longer get the funds needed to run the business, and it's just inevitable. It's going to die.
Can't cover the cost of capital.
Yeah.
Yeah. Okay.
So obviously they're over leveraged is the whole point.
Those are over leveraged. That sounds like a crummy business. I wouldn't want to be in a business that was, just barely on a razor's edge between the cost of the capital and profitability. I'd find a better business than that.
Yeah. Well, there's examples of people out there that are doing factoring. They're selling their receivables, and they're trying to rob Peter to pay Paul, more or less. You've got the money, but you can't wait for it to be paid. So you're going to get it leveraged. And obviously you're paying your bills, but you're sacrificing a lot of your margin.
Yeah. I know companies are like this that have big revenue and very, very small true earnings.
Yes.
And I always thought to myself, boy, I don't know that I'd want to risk it like that. I mean, it's what revenue with no profit is like risk without reward.
Yeah. Yeah.
Yes, there are a lot of businesses that run on a razor's edge like that. Manufacturing, high volume manufacturing is an example of that.
Yeah. So just to kind of wrap this up, I started by asking you about debt and how I am debt adverse. And fortunately, I'm in a position where as a company, we have revenue and we have cash. And so I'm feeling pretty good about it. And hearing you originally and still hearing you now, I feel like I should be a little bit more leveraged.
No, I think that you have to weigh it against your risk tolerance, and you have to be able to sleep at night.
Interesting.
Right? I'm just saying, everything held constant, it doesn't matter. It is not a feature of a business that it is debt free. Every business is debt free because the buyer is going to pay off the debt at closing.
Correct. Okay. All right. Let me change topics then.
Okay.
And this is going to be an interesting one too, because recently experienced this. In the last year or so, I've been in conversations to purchase different things and so forth, and we've had a variety of conversations. One of which recently was a company that did not have financials for the particular product or division, let's say, that they were wanting
segmented
to offer.
Financials.
There you go.
Okay.
So at the end of the day, they were trying to extract from their financials what the revenue and costs were to produce on an Excel spreadsheet. This is in essence what the company is earning. And yet it was, nothing that could be audited. I didn't have access to financials. They were more or less kind of stripping out of their own financials what they felt were relevant transactions and trying to create this spreadsheet. I was astounded that this was even happening, but yet that was the nature of the conversation. When it came to getting capital, I couldn't get capital, obviously, because nobody could trust the financials that were being produced. So what are your thoughts as it relates to accounting professionals that don't go to the point of being that detailed, breaking down, characterizing everything so that, either product lines or divisions of companies are segmented?
Well, sometimes you can't blame it on the accountants. They are recommending to their clients and prospects, and their clients and prospects overrule them, right? If you don't have segmented financials and you go back and you try to figure out a pro forma of what that division may or may not have made, it's nearly impossible and doesn't have much credibility. I worked at Citigroup years ago when we were working on a very big transaction, and We had Deloitte come in and try to do that. This is 15 years ago. They spent $400,000, and at the end of the day, they said, "Yeah, we can't figure it out. Sorry, thanks for the $400,000." This is a $600 million deal, so it was worth the risk of spending the 400. But you can't get in the Wayback Machine, because that's really what you need. You need to get in a time machine to get back there and make these changes. You should always be thinking of, hey, is it possible that this division could be spun out? That we might want segmented financials so that we can really understand the profitability of this division, so we can know if it's a loser and we should close it down, for instance. Clients are very resilient to spending money on accounting unless somebody can explain to them in a language they understand about why you should do it. But your accountants should get better at being able to articulate this to clients and prospects. I've got tons of stories and whip marks on my back, examples about how I got burned. I didn't earn a fee because I couldn't figure out the accounting. We couldn't go back in time and fix it.
Yeah. No, this is really insightful, simply because of the fact that I know in many of my clients, just the chart of accounts is so sparse as to what's really going on in the business. How do you make money? And it's not just a sales line that says, here's where the sales revenue is. It's a single line, and we just deposit these funds, and that's what's happening. It's infuriating to me. I want to get granular with them and actually go, okay, what is selling? What's going on here? And then it's the cogs associated with each of those types of things.
Right.
I really like the granular side of it. And every client I've worked with, it's always started with the top line revenue. I want to itemize that as best I can. And then it's, as you're describing, it's segmenting it out. Do you have divisions in your company? Is there something going on here that we can separate and kind of detach everything and show, is this truly a profitable venture? And that's, I think, very, very telling. And coincidentally, in my own business, I'm always wanting to do that. And I'm currently experiencing that even now myself. So this is, I think, a very real scenario that we're describing.
And you need your level of professionalism and granularity on a very low margin business, because if not, you're out of business. Right. Or maybe you fine tune it and you go from 1 to 1.5%, and you've increased profit 50%, right? That's very, very important. What you find is when you have an entrepreneur that has a business where it's high operating profit and high gross profit, they can get away with it. They don't have the discipline because they've never really needed to do it. Now they're throwing money away. They don't realize it. Certainly they're throwing more money away than it would cost to have an accountant go in there and help them. But this is what happens when these companies go from 10 to 50 to $100 million. Now you've got real professional management that knows how to hire accountants and people that have their own P&L that they report to, and it gets more granular, and you turn that dial and you really squeeze out profitability in different divisions. But when you've got a company that's $10 million, sometimes it's run by a guy or a gal that is Superman. They run the business. They don't run an organization that runs the business. Running an organization that runs a business is what you need to do to get to $50 million. And that takes middle managers that are paid a lot of money. Accountants, a controller and a CFO, those must be $100,000 to $200,000 these days.
Yeah, very, very true. Well, what you're describing is something I'm experiencing. It's something I've experienced with clients in the past. One example of that would be, I refer to them as sacred cows. It's typically an initial product or service that they're offering when they began the company. And over time, it's no longer the cash cow that it once was. It no longer has the margins that it did. But yet they feel as if it's a legacy product or service that defines who they are. But in reality, they're losing money, or it's just not as profitable as something else that they've later created or done. And the beauty of it is they hold on to it, presuming that it defines them or that it's kind of nostalgic, but it's losing them money. They should be putting their advertising, their time, their efforts into something else that's far more profitable. And once you, through accounting, can help them realize it, because you might be able to observe it, but the accounting will demonstrate it. And all of a sudden you bring to the attention of the business owner, by the way, this has been a thought, but now I can show this right here, you're wasting advertising dollars on it. If you spent the dollars that you're spending here on this particular product on this other one that's far more profitable, you'll actually see a lot more growth in your organization. And it's that painful, but that's what we started with, but that's who we are. And it's a decision they have to make.
Yes. And that is some of the synergy that private equity or buyers in general get, right? They show up, it's a $50 million business, but they can tell that it's been run like it was a $10 million business. And they see the opportunity to spend the money on the accounting to figure out what dials to turn to increase profitability, increase gross profit, and increase operating profit. And maybe it involves shedding lines of business, SKUs. Absolutely, there is a ton of slop isn't the right word, but there are a ton of inefficiencies in businesses that the next management, the more professional management, should be able to figure out. Hopefully, it won't cost them more to figure it out than the actual savings, the gain. But as you get bigger and bigger, the accounting doesn't cost that much more at all. You need it. Absolutely, you need it. That's why blue chips are more valuable. That's why publicly larger or publicly traded companies always trade for higher multiples, because they're more stable, they're more safe, because you can answer the questions. It's tougher for them to have a division that loses money over time and nobody knows about. I mean, somebody knows about it. Somebody's P&L is responsible for that.
Yeah. Okay, let's go to my third one. Third one is you've got companies, at least ones I've seen, that have started, but it's all with the intention of 3 to 5 years from now we're selling it. They come in with venture capital. They're really leveraging everything. They're typically in debt for those 3 to 5 years, but the exit is we're going to sell it for something. Yet they're oftentimes in debt. That was that reference I was making earlier. So how do you actually work with a business like that who intends to sell in 3 to 5 years and you're watching them from the start? I don't know if you've ever interacted with someone or been involved with that type of a transaction, but I'm looking for what, from an accounting perspective, should we be helping with in that scenario when somebody's literally coming in saying, my intent is to walk away from this in 3 to 5 years and I'm in the beginning stages. I'm not going to have anything that's 4 years old, 5 years old necessarily as it relates to the financials.
Those are my best clients. Those are the most professional ones. And those should be the most profitable ones and most professional ones to interface with for your accountants that are your clients.
Yeah.
Think about it like a pyramid. The bottom of the pyramid is the $10 million or the 10 million businesses in America that are under $2 million in revenue, right?
Yeah.
They have no debt because they can't get any debt. They aren't that professional, but they are being run by people who are very talented and they're very hard workers. And they just produce financials because it's required to produce tax returns, right? The next level is somebody who is about to get a bank loan, right? Suddenly, these things are more important because the bank's asking for them.
Correct.
Right? So they are, their discipline increases. The next step after that is a company who you said was took on debt, took on maybe equity investment or private equity investment or venture capital came into the company, or a large credit facility. That's an even higher level of scrutiny required. And then the highest one is somebody who has debt, has venture capital or private equity professional ownership behind them, and knows they're going to sell in the next 2 or 3 years. They need the highest level. It takes a while to get somebody from the bottom of the rung to the top of the pyramid because each one of those steps is a lot of work and a lot of discipline and takes time. But if they already have venture capital investment, they're already answering to passive shareholders. They already know how to produce financials, quality financials, because those investors demanded it. Although I have seen situations where friends and family, they don't know to ask.
Yeah.
Right. Even angel investors, they don't really. They're really the first professional investments come from venture capital firms that lead the round. They know how to say, you will do the following and you will produce these reports on this cadence. I need it in this format and in this cadence.
Yes. I loved the triangle because as you were describing it, I can see my clients in those different phases.
Yep.
Clearly, those at the bottom rung, those that are the business owners that are 2 million or less, yeah, they're running a great business, but it can be sloppy at times.
Yeah.
Their accounting isn't current. I would dare say it's the least necessary. They
Right.
are doing it oftentimes more from a tax motivation. They're
Mhm.
just thinking this is what's necessary to be in business, so I can file the return.
Mhm.
And so they're just going through this because they're focused on growing the business.
Mhm.
But once you get out of that phase and you now need, like you were describing, that bank loan, you're clearly in a position where you've got to be a little bit more deliberate and intentional about the financials. You're a little bit more beholding to the accounting profession. You're
Mhm.
a little bit more interested in the financial reports at that stage of business. And so you're willing to pay for the accounting. You're willing to actually interact with your account because they have things to share with you because someone outside of the organization is now asking you information. That's the banker and so forth. So that's really becomes interesting. The other part of the interest there is I think that they, as business owners, are starting to make money themselves.
Mm.
And because they're starting to make money themselves, the tax ramifications of how the business is structured, how they themselves are being compensated, all those things start to matter to them. And that ties them to an accountant, a bookkeeper, a tax preparer. All those things become relevant to them. But then you get up into these other things where you've got investors that are clearly involved. Well, they've got demands, they have needs, and they're going to be expecting things of you. So this hierarchy, as you're describing it, is clearly something I've experienced myself.
I can't believe in my career I've seen it so many times, and I've been guilty of it myself. I get to December or worse yet, January, and I have missed opportunities that I really should have taken the prior year.
Mm-hmm.
Yeah, sure, I can still fund my SEP, IRA, traditional IRA before tax day, but I've missed opportunities throughout the year, especially as you get to be a more sophisticated business where, maybe you can open up a captive insurance program to shelter.
Yep.
I think that if accountants spend the time to have forward-thinking conversations with their clients and their prospects, I think they will generate more business and they will certainly add more value as you deepen that relationship and mesh it with the entrepreneur. And that relationship will be stuck, not just sticky, but stuck, right? Until they sell. But then it could be at risk if they sell. But they should be asking their clients and prospects, what do tell me, are you going to leave this to your kids? Because that's really the only scenario where they wouldn't exit the business,
Mm-hmm.
right? Everybody is going to be separated from their business someday. That's a fact.
Yes.
Right? Oh, and what percentage of them leave it to their kids? Very few. I don't know the number, but it's teeny. Usually these great entrepreneurs, they don't create, actually they create soft times because they're so wealthy that their kids don't want to work as hard as dad.
Yes.
Right? So they need to if they're not going to give it to their kids and their kids can't do it or don't want to do it, then they need to get ready for what happens next. Otherwise, they could die at their desk and the wife is going to be stuck with this problem.
Yeah, no, these scenarios that you're describing are very common. All right, so I want to talk about entities, and I don't know what the answer is going to be to this, but clearly from a business point of view, there's value to be an S Corp, a C Corp, an
Mm-hmm.
LLC. So there's a lot of strategies that go on there, and there's liabilities that are being kind of deferred and so forth. But from a seller's point of view, a buyer's point of view, is there an entity easier or better to work with than another?
Absolutely. Early in my career, we saw a lot of C corporations and we scratched our heads and said, there is no reason for this to be a C corporation. They should have converted to an S Corp or an LLC years ago. And their accountant never gave them that advice because their accountant never had a conversation about a sale. C corporations are what you did in the 80s and 90s. I don't know when LLCs were invented, but it wasn't in the 80s and 90s. It might have been in the 90s. But now they're the most popular formation in LLC, unless you're going to raise capital, in which case you can be an LLC and you can switch to a C corporation and do that just before you actually effect the transaction. So don't become a C corporation thinking I'm going to raise capital someday. Start off as an LLC, and then eventually, you can switch to a C corporation. If you're starting off as a C corporation
Uh-huh.
and you want to sell and you want to sell stock, it's not a problem. If you want, if maybe you have to sell stock. There's some reasons you have to sell stock, and maybe a C corporation doesn't give you heartburn. But if you were a C corporation and you want to sell assets, there's two levels of taxation, right? There's a level of taxation on the corporate side and then on the personal side.
Uh-huh.
I don't think in my career I've ever seen a transaction where somebody sold stock in a C corporation because it's such a double tax hit that nobody wants to do it. Oh, you might say, okay, fine, I'm going to convert my C corporation to an LLC or S corp just before the transaction. Nope. The IRS makes you wait, I think it's either 5 or 10 years to get pass-through treatment. So I've been the GOAT many times. Not greatest of all time. I mean the GOAT in the old sense, meaning like I deliver the bad news. I've told a client, you got bad advice from your accountant. You're going to get 2 levels of taxation because nobody's going to take on these contingent liabilities around here. They're going to want to buy assets, not stock, and you're going to get stuck with paying tax twice. I'm going to kill my accountant. Well, okay, we'll see you in 10 years when you switch over to a pass. So, accountants really need to be having this conversation with their client. The clients won't ask the accountant. You got to ask your client,
Yes.
When are you going to sell this business? How's your health? Hey, I noticed, you're 60 years old. That's great. When do you want to retire? And start planning for it right now. You can be the hero. Where I was the GOAT, you can be the hero. You can switch them to an LLC or an S Corp right now, and then wait the 5 or 10, I don't know, it's 5 or 10 years these days, but wait the amount of time until they get that pass-through treatment. Then now you're the hero.
Very, very good. No, I'm loving this. All right. So let's talk now about a few things that I think are more of a rapid fire. Let's go through this and see what you have to think of it. So I'm curious, when you're talking about employee agreements, phantom stock, when you're looking at what the company is organized as, especially when it's the employees being involved with the transaction. Any advice on that?
Well, we just talked about entities and how they're organized. I think that you always need to be worried about key employees.
Okay.
Key employees, at the end of the day, we are all replaceable, right? But there are some employees that that would be extremely difficult to replace, or it would be expensive or very disruptive for your business to replace. In those situations, hopefully those people are co-owners with you. If they are not, you may want to think about making them a co-owner. And you can do that in a number of ways. You can give them stock, but I wouldn't recommend doing that because let's say they leave, and how do you get back that stock? Or let's say the relationship sours. There are ways to make them an owner. One of them is a phantom stock plan. That's a situation where you make the stock, you say you will own 10% of this company upon a certain event, maybe a sale, right?
Uh-huh.
You start calling them a partner. They're a partner. They're an owner of the business. It doesn't matter what you call them. They're an owner of the business, right? But in that phantom stock plan, they must be present to win. If they quit a month before the sale, they don't get anything. So it's a carrot you put out there. That might be enough to keep them around. That might be enough to make them feel like they can work late every night because they're building something for themselves. Not just you, but something for themselves. And so phantom stock is a great way to do that. That doesn't complicate your cap table and doesn't create a problem if they leave.
So I've heard of accountants who, in lieu of compensation, have done various things that are quite creative. This might be one of those that you've seen where they actually, in lieu of services being paid for by payment, they're getting equity in a business.
Yep, I've seen it with attorneys too.
Yeah.
Like startup attorneys do that.
Exactly. Yeah. So all of a sudden they've got skin in the game, therefore they're going to do the services, but you're referring to it as one method might be the phantom stock.
One method might be the phantom stock. I'm thinking in particular about a key employee, just in case there's a I don't know, maybe they don't get along or something and something happens and the parties need to split. That's less common with a vendor like an accountant.
Okay. All right. Next question. Regarding the balance sheet P&L, Is there anything in particular that you're looking for as you're assessing the valuation of the business or preparing the business to go on the market?
Sure. Yeah, I think I touched on it before, but I always like to see, the first thing is I want to see 24 months of balance sheets in Excel. They can be in a PDF. I just want to see it monthly, right? I want to see the monthly. And I want to look at the balance sheet carefully. I want to see the trends. Is the inventory number the same every month? Okay, why is the inventory number? Oh, okay, well, don't you do cycle counts? So shouldn't you have different inventory numbers every month? You should tighten that up. You need your accruals. The buyer wants to see all of the accruals in there. You need that to close the business. You need that at the closing table to calculate the working capital 90 days post closing. It'd be nice to get it ahead of time, because then your bankers can figure out what the adjusted working capital trends are on a trailing 12-month basis by month, every month going forward, right? If those accruals aren't in there, I'm not getting a true picture of what the working capital needs of this business are. So you're going to have to spend the money to get them in there. Get them in there at the beginning so I can understand the working capital trends. We can, a lot of times our clients, again, conservative clients, I don't have debt. As soon as a payable hits my desk, I fire off the check right away, right? On the other side of the equation, they're getting stretched out on their receivables. Not much they can do about that, right? And they might hold way too much inventory. Maybe because when they started the business, they said the only reason people come to us, we're a distributor. The only reason they come to us is because we have all this inventory. They might be able to reduce their inventory a little bit. And let me tell you the benefits of those three things with working capital, right? Let's say you fire off your payables right away. And let's say you're getting stretched out on your receivables like everybody is, right? And let's say you have a lot of inventory, maybe too much inventory, okay? Your buyer is going to expect that the balance sheet tendered at closing looks like the average balance sheet over the last 24 months, okay? Which means you are going to have a very high working capital number. If you have too much inventory, you have no payables on there, and you're getting stretched out on your receivables. So you could work with your clients and prospects to help them collect their receivables faster, offer discounts, right? Maybe even get in there and say, hey, let's see an AR aging report. Hey, we got a lot of junky AR. Let's write this off right now. Let's take the deduction. Get rid of it right now. Yep. Inventory. Do we have any bad inventory? Let's look at the inventory report. Let's get rid of this inventory right now. And payables. Why are you paying the second it hits your desk? Your terms allow you to pay in 30 days, maybe longer.
Earn the interest.
It's not just the interest. Because I know there's not much float, especially at low interest rates.
It's the balance.
It's what it does to your working capital target.
Uh-huh.
And by the way, okay, let's say I just convince you to do that. It might take you 6 months or a year to turn those dials to get it right. Okay, now it takes you another year to have a look back that is optimized, right? I'm explaining it at a very high, wonky level because your audience understands all this. They're accountants. The clients won't, but they can dummy it down for the clients and explain, hey, you're going to leave millions of dollars in the deal. Okay, you sold your business for $50 million. Yeah, but you had to give them a $10 million balance sheet. What if I sold the business for $50 million and we gave them a $5 million balance sheet? Didn't the investment banker and the accountant, didn't we just put $5 million more in the pocket of the entrepreneur? $5 million more in shareholder value?
Uh-huh.
So, that's one difficult to explain reason or area where accountants and investment bankers can work together for the benefit of the client.
So one of the things that really stood out to me is, first of all, the receivables. Love it. I've had that conversation numerous times as to how to manage receivables. There's aged receivables.
Right.
We've clearly got entrepreneurs that think, oh, it's a friend, it's a family member, it's the guy down the street. I know him. He'll pay me eventually. Well, the problem is it's 120 days old. It's 300 days old. And for whatever reason, they're just not watching it. And therefore, they keep it on the books and they look at the AR and they're saying, well, I'll eventually get all that money. No, you won't. And so getting in there and actually working with them to manage the receivables and effectively work that receivables process is very beneficial. And the faster you can bring in that money, the better, because the receivables does do value in the business. And that's one of the things that I think is maybe too often overlooked because of the optimism of some of these business owners. The second is payables. I agree with you. Holding on to the money and letting the bank account grow and actually show that it doesn't have those large dips because of the fact that you're spending the money so quickly.
Right.
You're holding in as you retain it. You're able to show that the bank balance never dips below this certain amount. And if you're managing it appropriately, it gives a much better impression of the business because you always have on hand a certain level of funds. That's hugely important.
Huge.
And so that comfort you may get of paying the bill because you have the time or the money to pay it. No. Pay later. Hold it. It's good. It's a good thing. And so having that account grow is a nice thing. And then as it relates to inventory, and this is one of the things I wanted to dive into, is clearly it's the inventory that can be a problem for businesses. They don't do the inventory. They don't know what they're holding on to as assets. They don't realize they've got things that are now out of date. I just went through this whole process literally just a few weeks ago, realizing that we had on the books a number of things that we no longer utilize, we no longer sell. They're just sitting there. They're being warehoused. We're spending money on storage. And at the end of the day, it needed to be gone. And there was optimism of, we'll eventually use it. We'll find a use for it. At the end of the day, it's not true. And so we had to do that purging. And that's a healthy process to go through in the business to do that assessment. But if you're not doing the inventory regularly, you're not going to find those opportunities.
Well, inventory is a subset of COGS, right? And COGS is a subset of earnings. So if you have bad inventory, you take the loss, get rid of it. Your buyer is going to be smart. They're going to figure it out. They'll commission quality of earnings and they're going to take it off. When they take it off, that's going to do bad things to earnings in that period, right? So you should, optimally, you should clean it up years before. Because let's say you take oh my gosh, we got all this bad inventory. Oh, and we've got some bad receivables, okay? Well, really, you have to now figure out how long did it take you to accumulate that inventory?
Yes.
How long did it take you to accumulate those receivables? And you have to make the adjustment, or somebody's got to make the adjustment by month to figure out what the actual earnings are of the business by month. You just can't write it off all in 1 month. I guess you can. You can get away with it for taxes, I'm sure, but not with a sophisticated buyer who is trying to figure out what are the trends of profit, gross profit, operating profit, trends, and actual nominal numbers by month over the entire historic period.
Yeah.
It's complicated, and these adjustments, they when you write off a inventory or an account receivable, you now have to figure out how long did it take to accumulate that, and I have to make adjustments. Guesses sometimes.
Yeah. Well, you're just giving a testament again to why timely bookkeeping and accounting is so essential.
Absolutely.
It's not one of these last minute, okay, let's go ahead and now purge everything.
Right.
So no, I'm liking this. All right. So the next
Your
question.
clients don't understand any of this. I barely understand it, right? They don't have to, but they just have to understand. You have to be able to articulate what it's going to cost them to continue to run shoddy accounting.
Yeah. Well, I think from an accounting point of view, you're just giving testament to the fact that our business owners aren't going to ask these questions. They're not going to come with these strategies. These are perspectives that the accounting profession brings to the table to say these are best practices.
Yes.
Let's do this. And it's where we make a case for our services. This is why we're so valuable.
Right.
And so all of a sudden, we're avoiding these once in a lifetime, let's purge everything. No, this should have been done along the way, cleaning the books up and actually maintaining the receivables as they should be reflected,
Right.
inventory as it should be shown. These are the things that I'm really liking because I really think it gives pride back to the accounting profession.
Absolutely. And let me also say, I said this before, but I'll say it here again, that if you're having a problem, your client might be saying, well, of course you're pitching accounting services because you're making money when when we increase the amount of money we spend on accounting.
Yeah.
You know what? If it's helpful, make a friend in your local market with an investment banker like myself. Bring him or her in early. Let me sell accounting services. I don't stand to make any money off that transaction. So my credibility is higher. And just as in the future, when they decide to hire an investment banker, now my credibility is lower because I stand to make money, but that accountant can now leverage his or her credibility for my benefit. So it's one way a partnership with an investment banker can be 1 + 1 = 4.
Yeah, you synergistically help one another.
That's exactly right.
The business owner is able to get great advice from the two.
Mm-hmm.
So I like that. Yeah. All right. Let's talk about management reports, common management reports that you want to see, want to use, that are asked for.
Well, I don't know how often they're used in the operation of the business. You know, some of these big organizations that have 2 or 3 accountants making, out of their accountants, but they could be controllers and CFOs. They should be able to produce reports. Again, gross profit trends that's the first question that comes out of their mouth. They want to understand gross profit and gross profit trends by month over the historic period. And then they want to, and by the way, we haven't even talked about projections. So few of our clients can produce credible projections. Very few. Well, first of all, if you don't have tight historic financials like we've discussed, you don't even really know where point A is. So how can you know where point B is, right? So I think you start with historic, but then if you really want to add value beyond that, you can help your client answer the question. Help us put together projections for the next year, detailed projections, building up revenue, not just simply saying, we might gain 10% these accounts, and we might lose these accounts, and so all the other percentages will be the same. That's what most people do. But if your accountants can help their clients produce credible projections, I mean, that's not gold plated. That's solid gold in our business.
I love this because this is something we do yearly with not only my clients, but within our own business. But here's the question I have for you regarding the accuracy, because with the forecast, yes, you're using, let's say, 12 or more months of data to say, okay, here's the trend, and you're going to now forecast, here's what I presume is going to happen in the coming months of the next year.
Right.
You forecast out some things. Some managers are conservative. Not much change is going to happen. Others are very optimistic and progressive and saying, I'm going to launch a new product line. I'm going to hire more salespeople. They show this robust growth. Is there an optimal range of how accurate the budget is to actuals as it unfolds? I mean, are you looking for a budget that is within 10% plus or minus of actuals as it unfolds? Or are you willing to take somebody that's more wide in the losses or the difference between the two?
Well, it really depends on the volatility of the business, right?
Okay.
If you have tens of thousands of customers, it's pretty easy to have a smooth trend, right? But let's say you have 4 customers and you don't have take or pay contracts with them. They're just calling you, ordering products, right? It's you lose 1 customer, and 25% right there, right? Or maybe you gain 2 other customers. So I think the best way to look at it over time is, hey, put together a monthly. Let's talk about it monthly now. How far off were you? If you're off, if you're always low, well, then you got to be less conservative.
Yeah.
Right. I know it. Sandbags stop bullets. I get it. People like to say why. They have a theory.
Well, it makes you look good.
It makes you look good, right? However, then the information is less valuable. Your board or the managers are unable to make decisions because you're protecting yourself, right? So you really need to take a chance. You need to fine tune it every month until over a period of time you say, you know what, I'm getting better at this. These projections are getting better. And by the way, all projections are wrong.
Well, of course.
They're all wrong, right? So don't don't worry about perfection. We're just simply trying to get closer to the truth. Yeah.
Well, interestingly enough, just yesterday, we had our annual retreat as management. We were looking at year to date how the company was doing, and within the departments of the company, there were some that were underperforming as it related to budget and overperforming as it related to budget. And the ranges varied. The percentage of difference was different across the board. And obviously, as an aggregate, where the company is coming in, it's the summation of all that. The challenge becomes, as I'm running the company, what margin of difference do I find acceptable? Am I okay with a 10% difference, a 5% difference, a 20% difference? And to your point regarding the management, when I was in management, not running the company, but in management, I was comfortable to say, I'm going to be sandbagging. I'm going to play it conservative because it gave me an opportunity to excel. It gave me a chance to shine.
Sure.
I wasn't always in the seat of I didn't do what I said I would do, right?
Mm-hmm.
So early in my career, I was forecasting what I thought was possible. I quickly learned I need to project on what is proven technology is the phrase that we would use. What is the proven thing? Give me something certain that I can rely upon as the president was running the business. Now that I'm the president, I likewise want some certainty as it relates to the budget so I can make those decisions. But I've got some of my team that are a little bit conservative and they're happy to excel. I've got others that are extremely optimistic and they miss it every single month. And so it is that refinement, that dialing in of what's acceptable and, what can we celebrate? Because you're growing, but you didn't hit budget, or you hit budget, but really did you grow as much as you could have? So there's some good assessments in there.
You're kind of gaming it with either scenario, right?
Yep.
And then it becomes challenging for you because you go, okay, well, now I have to make adjustments because I know Bob is super conservative and I got to add 10%. Yeah. Bob should be fine-tuning himself because
Correct.
You need his best effort at really projections that hit it. He should be going over as many times as he's going under over a longer period of time.
Yeah.
And if he's not, he needs to adjust.
Yeah. So we've got budgets that go back years. I mean, for years we've been doing this. I dare say we've got budgets go back 20 years. So I can literally see how did the company perform departmentally and as a company as it relates to the budget. And I could say 50% of the time we're over, 50% we're under. I'm curious to go back and now look at that. I'm curious how optimistic we are or how conservative we are as our budgets were created and then actually unfolded with the actual numbers. Yeah, this is going to be an interesting exercise for me to go do.
I would look back and try to figure out how much you missed it on a rolling 12-month basis and then graph that too. Hey, are we getting more conservative? Are we getting more, what's the opposite of optimistic?
Yeah, optimistic.
Yeah, so.
Interesting. Okay. Next thing, hate to ask it, but I think it's funny. Personal expenses being tied into the business as part of the sale. The larger the companies go, I have to assume that there's a little bit better understanding of that's a no-no.
Yeah.
So I'm sure that's the case. But what I see in larger companies is as they make money, they start to do investments in, say, real estate and so forth.
Sure.
What does the buyer see that as? Is that an asset? Is that a distraction from the business simply because they don't want to acquire these non-business related assets? I mean, what does that look like?
The most dangerous financials are an entrepreneur who owns 100% of the shares and has no debt, right? Because nobody is putting discipline on them to do anything. When you've got a business partner, you usually there's some détente there, right? You don't run a lot of personal expenses through the business because if you did, you would have to run an equal amount of personal expenses through the business. So you just throw your hand up and you say, no, let's just not do that, right? When you have bank debt, that's another, now you want to show profit. You have to show profit. You're not trying to just simply save on taxes anymore, right?
Yeah.
So I think that a lot of it has to do with credibility. Sure, everybody runs some expenses through the business, and those should be easy for us to figure out by month so we can recast them out of the financials. Some recasts go the other way. You might, as a business owner, say, hey, one great feature of this business is I've got a really below market lease on my shoe business, my shoe business down the street, right?
Yeah.
Okay, great. Well, as a buyer, I'm like, okay, well, I have to adjust that up to market because that lease is going to expire someday. That's a negative recast. Okay.
Yep.
So sometimes us bankers have to make adjustments on a financial statement that go the other way, that do bad things to earnings. But it's okay. It's got to be credible above all else.
Yeah. Yeah.
They're going to figure it out anyway.
All right. So I've given you now 3 scenarios. Someone that unexpectedly needed to sell. What does that scenario look like from an accounting perspective? What are we hustling to get done if we didn't already have it in place? I gave you the scenario of the business that's proactively basically positioning themselves to sell. What are some of the things that they need to be doing? And then the third being, I've got this great idea. I'm going to get some VC, angel money, something to the effect that I'm just going to launch this and in 3 to 5 years sell this. You gave us some good insights on that. What did I fail to ask? What didn't I ask that I should know?
You cover the gamut pretty well. The longer a business is owned by a person, the more difficult it is for them to part with that business. If you're talking about a guy who sold a business before, a software company, and he starts another one, he's going to sell that in the next couple of years. You just know it, right?
Yeah.
If you're talking about a guy, well, this has been in the family for 45 years. We've been at the same location. I bought the business from my dad. Those are very difficult to sell. And I'm not talking about difficult to sell in the marketplace. I'm talking about very difficult for the entrepreneur to part with.
Okay.
These business owners are so identified with that business. They've leaned on that business for so many years. They've enjoyed the benefits of entrepreneurship, which are amazing in the United States of America, like nowhere else amazing, right? Incredibly amazing.
Oh, yeah.
You can leverage the U.S. banking system to your benefit, and let's say you go bankrupt. You're back in the game in 2 or 3 years. What other country can you do that in? So everything is tilted for the entrepreneur in the United States. But these companies that have been around for a long, owned by the owner for a long time, or been even worse, in the family, multi-generation, very difficult for these people to part with. He's an important man in his town. Everybody laughs at his jokes. Everybody returns his phone call. Anybody can be rich. Anybody can be worth $50 million. But when you're not, especially if it's a big fish in a small pond, it can become a problem psychologically when you sell that business. Anyway, the accountants should understand that unique challenge when it comes to their clients and their prospects. The software guy, that guy's going to sell. That guy will have no problem selling.
Oh, yeah. Yeah, he's just going to flip it and go.
Yep.
It's kind of like when we started the conversation. It's like real estate. They're not buying a home. They're buying a house. And
Yes.
so all of a sudden, they're just happy to churn it, flip it, and be done with it. So,
But in the first scenario, still, that person is going to be separated from that business someday, right?
Yep.
And so at the minimum, you don't want to leave a disaster for the spouse to have to clean up, and or the kids, or a combination of the two. And accounting is crucial to make sure that doesn't happen. Because I've been in situations before where the spouse calls me and the owner has died, and we can, but a lot of questions just can't be answered, and buyers apply discounts. First of all, the buyer universe will be a lot less because there's going to be nobody there to transition it. And they will apply discounts, and the reps and warrants will be beefier, and there's more probability of a clawback or some sort of lawsuit post-closing.
Wow. Now, you've brought together a scenario here that I need to ask that is twofold. Obviously, that scenario of the business owner that's the entrepreneur every 3 to 5 years selling the business versus the family-owned business that's been around, same location and so forth. But let's go to that family business. There's two scenarios I'm familiar with personally, having worked with clients where one, it's a divorce. So it's a family thing.
Okay.
Neither wants to separate from the business, but they want their equity. And so it's not a go-to-market in the sense that we're going to put this up and just sell it to any buyer. We're still going to try and keep the company. One of the two wants the business, but we have to actually separate equity out of there. And so that is an ugly situation because the family is tied to the business, and yet they're forced to make this transaction. The other happens to be where it's generational. The father, the uncle is leaving the business. They're becoming less and less involved in the day-to-day operations. The younger generation is saying, give me the reins. I want to run the business, but I don't have the equity, so I want to buy you out. And so the individual that's the owner happens to now be forced out because clearly they're being shown that they're not working anymore.
Right.
And the younger person wants this opportunity. And so you're forcing the transaction. In both of those scenarios, someone like yourself comes in, assesses the valuation of the business, and helps with that transaction. And of course, from an accounting perspective, none of this matters unless the numbers are there to help give precedent to what's happening.
Sure.
This is what the business is truly doing. In each example, I saw heartache, I saw frustration, I saw different perspectives of what the company was worth. It's amazing how different. I mean, you've got the accounting information, it's there, but yet the one who wants to hold on to the business wants to buy out the other for as least as possible. And the one that's wanting to leave wants as much as they can because they're walking away. And in each instance, they're coming back to the financials to try and determine ultimately what is this truly worth.
Reliance. They're relying on those financials. And look, I got a 25-year career. Probably got 3 or 4 more years left, and then I'm done. But I have had an incredible opportunity to see the creation of wealth and then been a part of monetizing that wealth for these business owners. $50 million, life-changing money.
Yeah.
The culmination of a business career for them, and in many ways for me, as I see this over and over again. I've had a front row seat to it. It's awesome. You know what's just as awesome?
What's that?
The destruction of wealth. Like you just described, in a divorce or in a failed partnership between partners who are arguing with each other. That is just as awesome in another, not in a good way, right?
Correct.
But just you're awestruck. And the difference is that in scenario one, it takes generations, sometimes decades, often years. The destruction of wealth happens much faster.
Yeah.
So in many ways, it's even more awesome because you see the whole thing just collapsing. In a lot of those scenarios, accounting is crucial. And yes, they would get some sort of business valuation. That really wouldn't be for me. Investment bankers, yeah, we do that, but there are business appraisers that do that specifically, and they go to court, stands up in court. They have all the letters after their name to be able to say they're an expert of that.
Mm-hmm. Yeah, no, the valuation of the business can have different levels. There's an initial valuation, an actual valuation, and there's companies that obviously provide that service. And for a fee, they're willing to go out and look at comps and actuals and see what's going on in the marketplace, and not only look at the balance sheet and see what the assets are, but they're really willing to go in there and really determine, like a realtor might, what this asset is worth. And then they're trying to come in, and hopefully both parties can come to a consensus of, okay, we agree that this is the ballpark that we're going to start from.
Right.
And then all of a sudden, now we can start, splitting the child, if it were.
Mm-hmm.
So yeah, it's an ugly thing. Awesome is an appropriate word because you can stand back and it's just, you're in awe of how these two individuals that clearly at one point were tied to the hip, now they're just biting one another, and it's an ugly fight to witness. And it's the destruction of the wealth in the process.
It is. And that it could be generational wealth. That gets destroyed, and it's really sad to see. I think a lot of this can be mitigated years in advance, and tight accounting is something that is very valuable here to mitigate the destruction of wealth. Because if somebody can rely on a third party and they know the accounting is tight, that's half the battle, right? Then the appraisers can come in and rely on that good accounting, and they can produce good reports that are pretty tight to value.
Perfect. I'm going to wrap this up. I think we've had an amazing conversation. I think just the topics alone have been very insightful to me personally, but as it relates to my clients, I've seen the applications. I'm going to summarize this, but before I do, I'm going to just talk to everyone about the offer that we have. Clearly, what we're talking about here for you as listeners is there's an opportunity to figure out what it is you can be doing as an accounting professional to better service your clients. So I invite you to go to the free resource section at universalaccounting.com or the episode description here today and get a copy of the book, Your Strategic Accountant. It's here in Your Strategic Accountant that we address for you what it is those services are that you should be looking to offer your clients to best meet their needs as it relates to their business. It's here you can shine and become for them their strategic accountant. And then likewise, get a copy of the book In the Black. In the Black is 9 principles that you can use to make your business profitable, yours, your clients, and really focus on those things that matter, both short-term and long-term. Lastly, I'd like to encourage you to get a copy of the book, Your Profit and Growth Expert. It's here you can actually move then into the advisory space. And like we've been discussing today, basically help your clients see the things that they're not perhaps aware of that you can bring to their attention. And that's one of the things that I think we can do much better as accounting professionals. So with regards to the summary, this has been a great conversation. A few of the things that really stood out to me is obviously at the beginning, we were talking about these 3 scenarios of different businesses. Clearly, each of them have a role for us as accounting professionals to step in and do our jobs and do it well. Do it timely. These things can come unannounced. And what we need to be aware of is as an accounting profession is we need to be providing accurate and timely information. Now, that being said, we have to, as an accounting profession, realize that we're not just there to provide the books and perhaps file the tax returns. We have an integral role in the lives and the success of our clients, especially as it relates to them being successful monetarily. There's going to be an exit. Inevitably, we're going to talk about that. And what we were able to decide today is that our working with say the brokers, the investment bankers, and so forth, enables us to actually put in the position our clients the most favorable thing that they can benefit from financially. The other thing that I thought was helpful was this conversation about debt. It was a surprise to me before, and I was happy we were able to dive into it a little bit more. Debt is not good, is how I've always been raised. It is not your friend. It's almost like fish are food. And so what I'm just going to do is avoid the debt. And you just basically opened up my eyes to maybe I need to be a little bit more willing to take advantage of the line of credit that I have and maybe go into a little bit of debt. And I've been exploring that since our last conversation. Like I said, I've been looking at opportunities to acquire some different entities with the intent of leveraging ourselves and seeing how we can accelerate our growth. So definitely willing to explore that and see what that might be able to or might look like. The other thing that I thought was important was the assessment of the financials, being able to look back over the last 12 months, and most importantly, in that process, find out what those trends are and really understand what's happening with the business on a month-by-month basis. And that led to a conversation also about how forecasting and budgeting is very important. The tighter we can be, the more accurate we can be, is a reflection of how well we know our own business. If in fact we're able to forecast well what's happening in the company, then it shows that we can in fact gear our business towards success because we know what the various levers and dials are to be working on because we know the company. So lots of things that I thought were gems from today's conversation. Greg, I appreciate you coming and enlightening us with these various insights. So any final thoughts?
No, happy to be here. Thanks for being invited back. I really appreciate it.
Yeah, this was a wonderful privilege. So for my listeners, let me just do this as a recap of everything. One, if you haven't already subscribed to the podcast, please do so. Love to have you subscribe, and most importantly, set your notifications to get notified each and every week when we release a new episode. As it relates to the show today, I want to encourage you to go to the episode highlights. We actually have at universalaccounting.com in the podcast section, highlights, where there's playlists where we go into other discussion items, things that may be more relevant to your business and what you're dealing with today. But there you'll find past episodes, such as the previous episode that I had with Greg that I would encourage you to go listen to. As it relates to GrowCon, I want to just mention, if you haven't registered, we want to invite you to come and join us in May. It is an annual conference where we have basically us as accounting professionals, owners of bookkeeping, accounting, and tax businesses, come together to hear from the experts and at the same time interact with our peers, make relationships, find collaborations that we can actually use to the benefit of our clients, and most importantly, meet the staff here at Universal Accounting Center that's committed to helping you be in business for yourself, but not by yourself with Universal. All about your success. Why? Accounting success is universal. So with all that being said, be safe out there, have a great day, and always remember this: accounting success is universal. Take care.